Hey finance folks, in part 1 of this series, we discussed how global liquidity trends affect the future of the stock market, followed by detailed analysis of what is happening right now. If you missed it, give it a watch. Now it's time for part 2, where we uncover why current inflation levels just won't go down. We look into the rising energy prices and the global labor shortage to understand what's happening. Plus, we'll discuss which type of stocks can perform well in these situations. So let's jump in and find out what's going on. You can skip to any part of this video using the timestamps in the description below. There was a prediction that World War III will be fought over crude oil or water, as these are the only tangible rare resources left. With the rise in crude prices and Russia using its natural gas supply as a weapon of blackmail, this is gradually turning out to be a reality. Like previous wars, this one will have a long-term impact on the financial status of our economies. The main difference is that the major side effect this time will be inflation, which is going to remain with us forever. Let's take a look at this graph showing energy expenses as a percentage of GDP, which is currently at 13%, almost nearing the levels last seen in the 1980s. It's observed that whenever the statistic is below 7%, the global economy expands on the back of lower energy prices. So the current levels of 13% are definitely a cause of concern. Therefore, if so many statistics are mirroring 1970s levels, it's reasonable to conclude that financial markets will follow suit. Let's reiterate this theory using the equity performance of Dow Jones Industrial Average during the decade of 1970 to 80. This chart shows that equity markets were range-bound for about 15 years when global energy expenses crossed the threshold of 10% of global GDP. We can expect the markets to experience a similar struggle in the coming months unless energy expenses recede. Increasing energy costs have undoubtedly pushed the world's transition to green energy. But what if we told you that energy firms already started planning for this through production cuts a decade ago? This chart by Rystad Energy shows how energy companies have reduced their capital expenditure since 2014, which is exactly the point from where developed countries started moving towards green energy. The minimal capacity expansion globally in the last 5 to 7 years shows that energy companies do not see further potential for growth in this line of business. However, because the fall in supply was accompanied by a decrease in demand as a result of the steady shift towards green energy, no significant price fluctuations in crude oil prices were observed. This was before the Russia-Ukraine war started and we all got a wake-up call about our dependence on fossil fuels. How long will this situation persist? Combining our observations from all the three charts we just looked at, the decline in supply has resulted in a lot of unmet demand, which has chewed up a lot of world economies such as Eurozone, Sri Lanka, Pakistan, and so on. It's nearly impossible to begin new capacity expansions today at levels sufficient enough to meet the demand in the short term. We don't have past capacities because energy corporations ceased expanding a decade ago, hence the prices are projected to remain at elevated levels in the near future. For several decades, the world saw continuous deflation as a result of globalization, with one huge nation driving this growth: China. Cheap labor and favorable policies transformed the country into a low-cost global manufacturing powerhouse. This entire situation is about to change now. Even if the COVID hadn't gotten the world weary of China, its own demographic profile would have done the trick. This graph shows that China's current labor force is reaching its age of retirement, and replacement for the same is unavailable due to their one-child policy. With less workforce available in the next few years, their cost of manufacturing is expected to grow, which will steal China away from its title of the cheapest manufacturer of products. China isn't the only one facing a demographic crisis. The European Union is about to witness a wave of retirements, with around 40% of its workforce retiring in the next decade. Whereas in US, labor force participation rate has been falling since the start of the 2000s. But news sources have a very different story to tell. Don't be misled by these juicy headlines. The true levels of unemployment in the nation have not yet been captured by these statistics. With people migrating back to their native countries after 2020 and never coming back, the US's actual labor force has decreased. Due to the fall in the denominator and increase in the numerator, the calculation of the current statistic is distorted. In such a case, the current unemployment rate does not accurately reflect the situation. How long will this situation persist? With workforce reduction, wage inflation has been on the rise post the pandemic, and the same is expected to continue due to demographic changes globally. The global median age is projected to surpass 40 years by the end of this century, with the highest levels in many Western nations, especially Japan and Europe. In addition to an aging population, Supply chain disruptions caused by the pandemic and the Russia-Ukraine war has intensified inflationary pressures. According to a recent PwC poll of 4410 CEOs worldwide, 55% are considering restructuring their present supply chains to two major models, onshoring and nearshoring. These principles are based on the idea of developing your own capabilities in your own country or in neighboring ally countries. Making ourselves self-reliant sure does sound like a dream come true, but it comes at a cost. All of the capabilities that we intend to develop in-house will inadvertently raise our production costs, resulting in inflation. Coming to the last part of our video, where we'll be discussing the type of stocks that will outperform the broader markets in such a scenario. For the sake of this analysis, there are two types of stocks, growth and value. What are growth stocks? Growth stocks are shares of companies that are expected to grow at a faster rate than the overall market or their industry peers. Investors who buy growth stocks typically do so because they believe that the company will continue to grow at a fast pace, which could result in the stock price increasing significantly over time. However, it's important to note that investing in growth stocks can be riskier than investing in other types of stocks. These companies are often less established and may be more vulnerable to market and economic downturns. What are value stocks? Value stocks are mature companies that have reached their maximum potential. They are typically associated with companies that are well established and have a history of paying dividends to shareholders. Value stocks are generally considered to be less risky than growth stocks, as they are often associated with more established companies that are less vulnerable to market downturns. Additionally, the dividends paid by many value stocks can provide a source of income for investors, which can help to offset the potential losses in the stock price. The disparities in earnings caused by fluctuating interest rates are one of the key variables that distinguishes growth stocks from value stocks. Since the current prices are anticipated on a discounted cash flow basis, growth equities are significantly more vulnerable in a changing interest rate scenario. The current market price of a growth stock is the sum of present values of all the projected future earnings. The discount rate used to calculate their present values includes the prevailing interest rate. Hence, in a rising interest rate scenario, these stocks are discounted at a higher rate, making their current valuations expensive. In simpler terms, when interest rates rise, the cost of borrowing money increases, which can make it more expensive for growth companies to borrow funds for investment and expansion. This in turn can slow down their growth rates and reduce the expected returns on investment. As a result, when interest rates rise, investors may see these companies as less attractive compared to other investments that offer higher returns or lower risk. It is safe to conclude that growing capital costs tip the scales in favor of value stocks. In such a scenario, however, not all value companies will outperform. Increasing interest rates also exposes the zombies among them. Zombies are the companies that go from paycheck to paycheck. That is, they earn enough revenues to service their interest payments, but they cannot pay off their entire debt. Rising interest rates increase the risk of these zombie companies going under. If that's true and a continuously increasing cost of capital does result in the purging of these zombies, then even the value stocks are vulnerable to rising interest rates. So only the companies with healthy financials in the value space will be the clear winners. Healthy financial means companies that have either no debt or debt that is manageable. Overall, while the interest rate hike cycle appears to have paused for a few quarters, we can finally see a top approaching, but this does not imply that inflation is going to fall. If you have been following the debt ceiling debate and the fact that United States is set to increase its debt by $1.4 trillion this year, falling inflation rates are out of the question. The only way we will see growth stocks bounce back is if interest rates are gradually reduced, which will not happen for another year or two. Until then, happy investing, and if you liked our content, please subscribe to stay up to date on our upcoming videos.